Welcome back to Fast Track, brought to you by Aera, the podcast where we help you get into your first home faster. I'm Chereè, and with me is Aera founder Derek Handley. In this episode, we're going to look at bank math, not girl math, bank math, how it works and why you need to understand it as a first home buyer. But first up, Derek, let's take a look at some interesting headlines. You may have seen this one. We put it up on our socials as well. It's a really inspiring story about a Hamilton teenager who bought his first home. So yes, teenager. He's 19 years old. His name is Zach Kendrick, and he bought a 3-bedroom house for $520,000 without financial help from his parents, so no bank of mum and dad there. Instead, he worked as a welder. He worked 60 hours a week for 6 days a week, so he really put in the hard mahi there. A key quote that the article pulled out as well when they asked him how he did this, he said he drove a shitbox, so a cheap old car. And he also used the kāinga or his first home loan, which meant that he only needed a 5% deposit. So another really good hack there that he tapped into. His story got a lot of comments online. Most people were commending his efforts and saying this is really awesome and really great to see, particularly with the cheap car element. And it's something that we talk a lot about with members too. And we get a lot of members who have gone and financed a really expensive car and they've decided to sell it because they, once you explain to them how that can affect things. So let's unpack this story. I mean, first of all, the cheap car can really make a big difference, particularly in your younger years when you're trying to save up.
Yeah, I think first of all, a 19-year-old can buy a house in New Zealand.
Yeah, that's incredible.
Right? So again, just the narrative we keep telling ourselves. In almost any part of the country, there are houses for $500,000. That's another thing people keep telling us that's not true. So we have an example of someone who's beating the odds on so many different levels. Number one, he's not even 20 and he's bought his own home. Number two, he's found and bought a house for $520,000 somewhere in New Zealand and it's got multiple bedrooms. It's not, as a lot of people accuse, it's like a shoebox.
3-bedroom too. Yeah.
Number three, yes, he's got this mindset around the car, but there's other things I think that are really interesting about what he's doing too, which we also have in the book and the whole approach we have to everything at Aera, which is he's doing 20 hours a week more than the average person feels is what they should do. So if you want to buy a house, working 60 hours, driving a shitbox, and believing you can buy a house for $500,000 is a pretty great start. And that can apply to almost anyone, almost anywhere in New Zealand.
Exactly. There's a lot of big truths and kind of realizations there for people, right? Yeah, and as you say, especially there are houses, nice 3-bedroom houses for $500,000, and he bought in Hamilton, which, for a lot of people living in Auckland might not be that far to look to buy your first home. We know a lot of people that have done that just to get into the market.
Yeah.
I think
and in Auckland, there are things for $500,000. There might be an little apartment or a 1-bed, but they exist. So it's not something that couldn't exist here either, but not everyone lives in Auckland. Most people don't live in Auckland.
Yeah. So how important is it to look at all the different aspects? And we talk a lot about hacking the system. There are these sort of roadblocks for people like, oh, house is $1 million, I can't buy a house. Or, oh, I've got a bit of debt or an expensive car, so I'm just going to throw that away. Or I'm going to have to settle for a really small house, shoebox, throw it away. But there are all these elements where at every sort of roadblock, there is actually a way around or through it. It's just about changing perspective and doing a bit of research as well.
Exactly. But, this guy represents so many of the approaches that we endorse, which is the earlier you buy it, so your lifestyle hasn't crept. He's made the decision to buy it as a priority as a kid. He hasn't got a family. He doesn't need, multiple bedrooms. It needs to be next to a particular school. He hasn't built up the bad financial habits where he's overspending versus his income, or he's spending to meet his income as his income grows because he's got his priority as putting all his money into his deposit. He hasn't experienced what it's like to have a new car that he bought with $35,000 of finance, like a brand new ute that made him feel really good driving on the roads. And so he doesn't actually lose anything by driving the shitbox for a while. But in a few years, obviously he's going to be in way better position than anyone that bought the ute on finance. So he's kind of preempted so many of these things that we suggest people really take seriously and employed them in such an amazing way to get into a house before he's 20, right?
And of course, you always get the commenters coming in and saying, oh yeah, but now he's got a 30-year mortgage and he's going to be like, and it's like, well, yeah, but he's building equity, he's on the property ladder, he's going to end up in a far better place.
And he's got two, I guess, boarders paying him.
He's got a partner that's actually moved in with him.
Okay,
so he's
maybe
bought
they've
it by
got two
himself,
boarders
but-
too.
Exactly.
So then
yeah.
they've got two flatmates basically paying most of the mortgage.
Exactly.
So
and
anyone's going to throw stones when they can't see it as possible for them. And that's it's 30-year mortgage. But yeah, that's what every single human who's ever bought a home, unless you've paid it in cash, has done.
Yeah.
And once you realize that it's actually a good type of debt, given that asset class continues to rise over time, then you can release that kind of, negative accusations against people.
Yeah. And by the time he's 50, he'll have paid that off. But by then, he's probably bought another property and he's been able to lend against it and he's built a whole portfolio. And
I'm guessing
he can
since he's
retire
already
early if he
so-
wants. He's
so
setting himself up.
goal-oriented.
Yeah, he's setting himself really well. And actually links in really well to the next headline I wanted to look at, which is actually around renting. And I've seen a few headlines lately that have said it's good news for renters. Things are looking a lot better. There's some stats that show that on average, renters are $1,400 a year better off this year than they were last year. We know that rents have been creeping up the last few years, and if you look at the trend overall, they do. But this year, things are looking a little bit better. And so people who are renting currently will be going, oh, this is good news. And we talk a lot about people that think, oh, I'll just keep renting longer term. I'll just keep renting because it's easier and it's supposedly cheaper. Which, by the way, I did the math the other day for one of our social posts. It's only $18 more a week at the moment to mortgage a $600,000 house with the average rent.
Right.
So, yeah, you might think it's cheaper renting, but the gap is still closing
it's
a lot when
closing.
it comes to,
Yeah.
paying rent or paying mortgage, and people will be paying more than 600-ish a week on rent. I've also seen something interesting where there's some more companies popping up that are offering what they're calling long-term rentals. So trying to help solve the housing crisis from another angle of, okay, in New Zealand, you can't really rent in one place long term. You generally get kicked out within a year or two. The landlords want to sell or whatever. So they're offering these rentals that it's like a home. You can sign to rent this for 10 plus years, basically. So it's setting up a good place for renting, but I want to talk as well about why it's really important to still, not to throw buying the first home out the window, because when you look at retirement, like we just spoke about with the 19-year-old Zach, later down the track, he's going to be so well set up, where someone who has found a long-term rental, great, but just thrown out the idea of a home, where does that leave them at that point in life?
I think, in New Zealand, the more people we have that are building houses or owning them to keep them for a very long time, to keep renters in them, is good. Because, if you want or are only in the position at the moment to rent, then having some sense of security around where you're renting is really important for your family and your children and whatever situation you're in. So for all the people that actually aren't able to buy a home for whatever situation it might be, the fact that there's more companies deciding that they want to be in the business of renting for the long term is really positive. And, Simplicity, the KiwiSaver Fund, is building homes just to do that. So build to rent, they build the homes, they own them, they want to keep them forever, and they want tenants to live in them and feel secure. So that probably represents like a tiny, tiny, tiny fraction of all the housing stock in New Zealand, because most houses are owned by mum and dads that own one or two homes. And they change their minds when their daughters come back from UK and they want to move into that house, and they kick the tenants out, and that's what causes the problem. So the fact that more people are doing it, I think, is really good. It doesn't necessarily solve the ability to buy your own home, and rent. It doesn't necessarily solve the rental price increases, unless they're somehow subsidizing it, because the last 30 years the rents have gone up 4.5% a year on average. House prices, maybe 6.5%. So you're still chasing an ever increasing kind of lead that you have to keep up with. And when we did the maths on what the median rent is today, which was $650 or something, and you forecast that out 20 years, that's $80,000 a year. So if you want to be a renter, then you need to be prepared to pay $80,000 a year in rent in 20 years. And I think that's something that maybe once you think about it, you're like, wow, that's quite a scary prospect, versus the capital growth you might have had if you owned the home, instead.
So I think we should rather be looking at rent prices going down, longer term rentals, good news for people saving up for a home. Because again, it gives you a good place to sit for a bit, but don't rule out that altogether. Look at it as an opportunity to save a bit more money every week.
Yeah, I think the theory of, and you often see clips on social like renting versus owning, and again, the maths is all kind of wonky. The theory that you can outrun the housing market by being a renter and end up more successful financially is all, it all trickles down to being dependent on you saving as much as you would if you had a mortgage, which is what a mortgage is. It's a forced savings platform, putting away money every week that you are otherwise not putting away. Secondly, putting that into assets and investments that grow at a certain rate. And thirdly, not touching it. Because the moment you pull any of it out, this whole idea of your growth of the money that you were going to spend on mortgage going into investments, compounding over 30 or 40 years and to outperform your house, it all falls apart. So it relies on someone psychologically maintaining the course for 30 years, whereas in a mortgage, you're forced to because it comes out every week, and you build your life around it. You're like, my mortgage is $600 a week. I live on what's left.
Yeah. I saw someone comment once saying, don't buy a house, buy a business. It's way smarter. It's like, yeah, that's great. But not everyone's a businessman.
Exactly.
Not everyone wants to buy a business or knows how to run a business.
And then you still have to have the money to buy the business.
And it has to be successful as well.
Yeah.
So, yeah, I think it's just when you put it like that, I mean, generally speaking, for most people, the mortgage is going to be the best thing to do.
To force them to keep their behaviors in check,
Yeah. Let's move on to bank math.
Okay.
Which I said at the start, it's not girl math, because we know girl math. We love girl math. Well, you probably don't love girl math. But bank math, which is something that we talk about in the book, The Fastest Way to Your First Home, and it essentially unpacks how the banks do their math. Tongue twister there. How the banks do their math. So how they look at your income to give you what lending power you're going to have. But it also breaks down stuff that a lot of people may not have realized about how much a credit card or car finance, as we spoke about before, can actually impact how much they'll lend you. So I wanted to unpack a couple of those key points so that we can help people understand better, like when you go to the bank and you're looking to get a mortgage, what are the things they're going to look at? So you can also be better prepared as well when you get to that point. So should we start with income, the basic one?
Sure.
When they look at your income, what are they looking at to get to the figure that they're going to say this is, so you kind of know as well how much you might be able to lend straight off the bat.
Right. So so in the book, we try and break it down in the different components. And obviously one is income. So how much you earn can impact or does impact how much they're willing to lend you, right? So a rule of thumb at the moment might be that they'll lend you 5 to 6 times what your income is. So that's by your base salary. If you have overtime and other things and there's a consistent pattern of it, then you can include that as well. Or if you decide you want to buy a house in 2 or 3 years and you think, I want more borrowing power, then you might decide to do overtime or have a second job that gives you an additional 10 grand a year or whatever. And then that would increase your borrowing power by, say, maybe $60,000. So the first thing is basically the formula of how much is your gross income, and then they times it by a certain multiple. Now, of course, there's all details behind it, like how much you spend on stuff, et cetera, et cetera. But for a normal person who doesn't have a lot of debt, in terms of they've got no debt, they've got this certain amount of income, there is a cost of living that can be associated with, say, earning $100,000 as a couple. And we know that, there's a certain amount of dollars that you could spend on rent, food, supermarket, et cetera. So it's possible because people are doing it all the time. So the way we think about it is it's not really about what you're spending now, because if you decide to buy a house, you can decide tomorrow to change all those spending patterns to match the $100,000 income household profile that the bank is willing to lend $500,000 on, So often I hear like mortgage brokers and people talking to people about what they could borrow. It's like, it depends on your spending habits. But actually, I think about it the other way around. If you want to buy a house, it depends on what you're willing to do in order to match the spending habits of what the bank would consider reasonable, So if you're spending on all the stuff in the last month, you're not going to get a mortgage. Fine, but you've just got to change your psychology, spend less, and then they're going to give you 5 times or 6 times what you earn, in 3 months if you show them that you can carry out that behavior.
Mm-hmm. And what if they have credit cards? Because this was a sneaky one that most people, even myself, didn't realize. If you've got a credit card, even if you never miss a payment, because everyone says build good credit, right?
Yeah.
It's a good thing. You're proving to the bank that you don't go into debt. But
I think we should somehow maybe need to research and understand exactly how you build good credit a bit more, because it may just be as good to be on the power bill and the sky bill at home, or even in your flat, to build good credit versus taking a credit card out, because people think that borrowing money and paying it back builds good credit. And in terms of credit scores, New Zealand is it's quite new in New Zealand. There wasn't such a thing. In the US, it's a huge thing, your credit score. And so figuring out how your credit score is built, I think, is maybe a separate episode we could do, because if people think they should get a credit card to build a credit score, but actually if they just paid their power and their Sky bill and their their Vodafone bill, that might be enough. You know what I mean? Because it's about not defaulting on stuff. So credit cards are killer if you max them out and then are paying 20% on them, right? That's
Yeah.
obviously problematic. Everyone kind of knows that. But the real thing that people don't know is if you've got 20 grand in credit card limit, the bank's not going to lend you about 100 grand that you could have otherwise for your house, because they're going to assume, even though you pay it off always, that you could at any point go and spend that 20,000. So having this beautifully clean, crystal clear credit card that you've always paid off and you always, pay the bill every day when it's due, it makes no difference in terms of what the bank's willing to lend you or not. What will make the difference is getting a pair of scissors out and cutting the card. Because then they're like, oh, now they can't have $20,000 of potential credit. Therefore, we'll potentially lend them another 80 to 100,000 on a home. And just that one credit limit could be the difference between whether you could buy a home or not.
Crossed over that little line, eh? And it's similar with the car finance, right?
The car is worse.
A little bit more complicated.
The car is much worse because it's not about how much is on the car. So like you own $20,000 on the car, it's about the payments. So often car payments are very compressed. You're trying to pay off a car in 3 or 4 or 5 years. The interest rates are really high, not as high as a credit card, but maybe they're like 15%. The payments sound low, like maybe it's $150 a week or whatever. But if you think about it from a bank's perspective, let's say a mortgage is, for easy, 500 grand, maybe your payments are 600 a week. If you are paying a car loan off, say, 150 a week, that's a third of what your potential mortgage payment would be. So that's probably what the bank's not willing to lend you. So on 500, it might be 150 grand, because you're like, if you didn't have the car payment, you could easily afford 600. But now you're paying 150, you're 450. And that's why it's such a massive hit. It's basically like swapping one for one, because now you can't afford that extra $100 on the mortgage because you're paying $100 on the car. So the numbers are outrageous. It's like if you're paying $100 or $200 a week on a car, you probably won't be able to borrow 100, 150K. And that, again, is going to tip people right over.
Yeah, so there's a couple key things there. Cutting up the credit card and looking, if you do have a car on finance, looking at the best option there, whether it is to sell it and cut ties, or if there's a little bit left, maybe can you pay that off quickly, or does that make a difference too?
I think it has to be gone. As long as the payment is still there during the period in which you might be buying and getting the mortgage approval, like, if you say you get a mortgage in January and the payment ends in August, you won't get the mortgage because they just got to assume you've got this payment the first 8 months. It doesn't even matter that it's going to be ended in 8 months. The best thing for all the people that we see in this situation, if the loan is like 20 grand or more or something like that, or 15, you have to sell the car and get a cheaper car, unless you can find a way to really quickly pay that car loan off. Because that $200, $150, $400 a fortnight, it's game over from a mortgage perspective.
Yeah. So buy the shitbox.
Well, why did
Like
you even
Zach.
why did you even borrow money to buy the car in the first place?
Yeah.
That's where it's like
instant gratification, though.
I know, that's the come to Jesus conversation you need to have with yourself. With why did I want this? What is it about? Because it's the worst thing to own. It's depreciating every day, not every month. And you're borrowing money for it at the same time. So you're paying 15% interest for something that's going down 30% a year. I mean, I know this is upsetting to probably all the people listening to this that are thinking about it, but you really have to look yourself in the mirror and go, why am I doing this? Like, who is this for and who's it helping? And if you keep the car for 5 or 7 years, you've pretty much lost all the value and you've paid for the privilege of losing that value.
And whether you like it or not, the bank math is bank math. So they're always going to do it the way that they do it, and you're never going to be able to really get around it. And
whereas the opposite is true. If you tell them the story, our coaches basically build the story when we present the case to the bank. We're like, this person, Chereè, she had borrowed all this money for this fancy new Lexus, but when she realized she sold it after, we told her to, and then she's downgraded to a, 2008 Vitz, and that's how committed she is to get this first home, and she's cut out her coffees.
Her a home loan.
And look at this little social video clip of her cutting up her Visa card. She's ready.
Yeah.
And that's a story you can and do tell when you work with a coach who then puts your case to the bank and they know how to explain everything. And that's what, the Aera First Time Faster team is. Yeah, and it's about optics. It's like, what is the story that best positions Chereè to explain the poor decisions she's made in the past?
I'm sure I'm not that bad. Come on.
I don't know if this is really true.
This is not a true story.
It's not a true story. It's a caricature of Chereè.
Yeah.
But you know what I mean?
Yeah.
Whereas when you go straight up to a bank and say, give me a mortgage, you've got no idea. The black box basically says, computer says no. And you're like, why, how? Whereas it should be the opposite. You put your best foot forward and your case, and that's what, our team is expert at doing. And in conjunction with, this is the house they're going to buy, which we found for them, which meets and matches all the criteria that we know in the background the banks would support.
Fantastic. Thanks so much, Derek. And thank you for listening and for tuning in. Check us a follow and subscribe, or on socials, fasttrack_pod. And if you loved this episode, flick it to a friend or family member. And we'll see you next time.